Would you like to learn the basics of an income tax return and maybe a little of the jargon that goes along with income taxes? Well, you're in the right place. I'm Amy Buck. I'm owner of PlanPath Financial, and you have found me at my YouTube channel, Retirement Planning 411. It's important, I believe, for us to discuss some of this lingo that goes into income taxes because the purpose of my YouTube channel, Retirement Planning 411, is to educate you about retirement planning, and I have a strong focus on the tax part of that because I want you to pay less taxes as you live through your retirement and leading up to your retirement and have more to spend during your retirement. So in order to have those discussions, I thought it would be nice for anybody who isn't familiar with them to do a little Income Tax 101 presentation so that you can join in on the conversation and not feel like you're getting lost in some of the lingo that goes along with it. So when we think about income taxes and doing the return, we can look to this chart right here to kind of show the flow of an income tax return. As we go through the actual form, these are the things that we are doing as we go through it. This is an example of the Form 1040. That's the form that you start with when you're doing your income tax return. There could be lots of other forms that go along with that, especially if you are doing itemized deductions or if you're self-employed, etc. But we start with the 1040. But actually, before we even get to that form, we start by looking at what all the income is that we have coming into our life in any particular year. Some of those things may be excluded from even being recorded on the 1040. So let's take a look at what some of those things are. They're exclusions from income. Those things include things like death benefit from life insurance. If you were to receive a death benefit, that is tax-free. That's income that comes to you and you do not pay tax on it. It does not go on your income tax return. Sometimes Social Security benefits are not reported and they are tax-free, sometimes not, and we'll talk about that another time. Tax-deferred retirement plan contributions. So those of you that are employed, you get a check through payroll. And before you get that check, you have made contributions into, let's say, your 401k, pre-tax contributions. So they're not being taxed when you make that contribution into the 401k. They're tax-deferred. And then the growth, once you've invested that money, is also tax-deferred. But eventually, once you get to retirement, and you start taking distributions from that, then you're going to be taxed on that money. So it's not like it's tax-free money. It's just money that has had its taxes deferred down the road. And next we have certain employee benefits are tax-free and do not come onto the form. Same with municipal bond income, gifts and inheritances. So if you received a $15,000 check from your grandma, she gave that gift to you, that is not something you have to report on your income taxes. Gains on the sale of a primary residence up to the exclusions amount, which are $250,000 if you're single and $500,000 if you're a married couple. Anything over that amount would have to be reported on a form, and then you pay capital gains on that amount above that exclusion. Workman's comp, child support payments, welfare payments, tax-free, not put onto the 1040. So once we get all of those exclusions from income, we come up with the gross income amount. And that is shown right here on this form. They also call it total income. So if you hear gross income and total income, we're talking about the same things. Now, things that do have to be recorded fall into this area that I'm putting my mouse over on this form. And you're going to know that you need to report it because you're going to get a form in the mail. So for instance, your employer sends you a W-2 form. That has to be reported as income. If you are a contract worker, you're going to get a 1099 from whoever you did the work for. That has to be reported. If you have interest income, if you took a distribution from one of your retirement accounts, you're going to get a form for that. That has to go on to the 1040. So in other words, there's a trail where the government knows that you've gotten that money. That needs to be reported. But these things that were on the exclusions list, you're not going to get a form for that. Therefore, you do not report it. All right, next we're going to take that total income or gross income and we are going to subtract the adjustments to income. Adjustments to income are also sometimes called above the line adjustments or above the line deductions. You may have heard that terminology before. This is what you calculate, what you subtract from that total or gross income to get to your adjusted gross income, your AGI. But some of the adjustments to income, other things that you can take away from your gross income, are educator expenses. So teachers, if they spend money on things for their classroom and to educate their students, they can take away up to $250 of income for that. HSA contributions, if you are making contributions to an HSA account and they have not gone through payroll. So you maybe have made some contributions through your payroll and maybe your employer has as well. Those we're not talking about. Those are not going to adjust your income because they've come out of your income tax-free already. But if you end up making HSA contributions, like additional contributions outside of payroll, you're doing that with money you've already paid taxes on, because if it's in your checking account, it's already been taxed somehow. And because HSA contributions are always tax-free, you are going to be able to get a deduction for that. And that particular deduction happens above the line, above the adjusted gross amount, but not the ones that go through payroll. Half of self-employment taxes, self-employed retirement plan contributions, self-employed health insurance deductions, any IRA contributions that you make, student loan interest, and alimony paid if your divorce was before 2019. Those are all taken away before we get to the adjusted gross income number, which is reported right here on the 1040 on line 11. Okay, so once we get to AGI, adjusted gross income, now is when we start taking deductions away. So when we start with standard deductions, most people now are doing standard deductions. And we can look at a chart like this one. This is actually for 2024, and those deductions have gone up a bit from last year. But you would just look at what your filing status is, whether you're single, married, filing jointly, head of household, etc., and it will show you what your standard deduction is. If you happen to be age 65 or blind or both, you get an additional standard deduction that would be added on to the one from this chart. That amount is subtracted from the AGI to come up with your taxable income. However, you may be somebody who itemizes. Now, since the Tax Cuts and Jobs Act of 2017, where it nearly doubled the standard deduction, not as many people itemize nowadays as they did previous to 2017. But here are the things that you calculate for itemized deductions, and then you can compare that to what your standard deduction is. And if your itemized deductions add up to more than what you could take for the standard deduction, then you probably want to itemize. Those things are medical expense payments in excess of 7.5% of your AGI. So once you have that 7.5 AGI number, you multiply it by 7.5%. If your medical expenses add up to more than 7.5% of your AGI, then you can subtract or deduct anything over that amount. SALT, you've probably heard that terminology, SALT. That's talking about state and local taxes. Income taxes, property taxes, personal property tax. You add all of those together and you can take that number as long as it doesn't go over 10,000. 10,000 is the cap for that deduction. Home mortgage interest, investment interest, gifts to charities, and any casualty losses if they were casualty losses that were tied to a federally qualified disaster. So once you add all those up, if it adds up to more than your standardized deduction, you're going to report it all on Schedule A, and that will become your deduction from AGI to come up with your taxable income. So taxable income is that important number that we use to calculate the actual tax bill we have for that year. So we take our taxable income, which is right here on line 15 of the 1040, and we do a little math. we multiply our taxable income by our tax rate. So the way that you find out what your tax rate is you go to a chart like this one. And this one actually on the top is for a single taxpayer, where the one on the bottom is for someone who's married filing jointly. So there are other tax rate grids that you might have to look at if you're head of household, if you're married filing single. There are other charts out there, but these are just two for example. So in this example, we're looking at what do these tax rates mean? So if we had a single person who's earning $58,000 a year, here's how the tax rates would be applied. The first $11,000 that person made would be taxed at 10%. The next amount between $11,000 and $44,725, which you can see here on this chart, is taxed at 12%. So there's another multiplication answer. And then lastly, any amount over that $44,725,000 and up to $58,000 is going to be taxed at 22%. So it's not that all of your money, if you, for instance, have that $58,000 a year income, and you look at that chart and say, oh, I fall in between these two numbers, that might be really hard to see, but that puts me at the 22% tax rate. That does not mean you're paying 22% tax on all of your income. That means you're paying 22% on the amount that fell within that particular bracket. You pay 10% on the first bracket, 12% on the next bracket, 22% on the last bracket. And then there's something called your effective tax rate, which is if we took that total amount of tax that you paid, divided it by your taxable income and got that percent, which I'm not sure what it is here. I didn't do that calculation, but let's say, for instance, it's 14%. I have no idea if that's right. That means that your effective tax rate would be 14%. That's really the percent of tax that you paid on your income, not the 22%. All right, moving on. Once you do that math, you have your tentative tax amount. But that's not what's going to determine what you owe the IRS, because we still have to take away tax credits. So not everyone's going to have tax credits, but here are some of them that are currently available. Some tax credits are refundable, and some tax credits are non-refundable. So any of these tax credits can reduce your tentative tax amount to get to your final tax amount. But some of them, like the ones in this first column, if when you took that refundable tax amount away from your tentative tax, there was money left over, you can actually get a refund for that money. If there was not money left over, but if you have a non-refundable tax credit, that is not something you can get a refund back for. You can take the tax credit, but if there's anything left over, that's not something that you can get back. So, and I'm not going to read all of these. You can see some of them: earned income, child tax credit, opportunity credit. We're not going to go into what all of those are now. Eventually, I'll have that information on the YouTube channel. But for now, we're just going to know that there's tax credits out there. Some are refundable, some are non-refundable. You subtract that from the tentative tax amount to get your final tax amount. All right, so that puts us right here on line 24, and that is your total tax. So if someone says to you, how much tax did you have to pay last year? It's not the amount you got back in or not the amount that you had to send into the IRS at the end of your tax return. It's all the tax that you had to pay, the stuff withheld out of your checks, any estimated tax payments that you made. That is what your tax is. So that final amount is put here on line 24. And then you figure out, okay, how much of that did I pay already through W-2s? How much of it did I already pay in with estimated tax payments, etc.? And then you do the math to see, okay, out of all the tax that I owe and how much I've already paid through all those different channels, how much do I still owe, or did I overpay? If you still owe, you're going to have a tax return that says you owe this much to the federal government, and you have to write a check. Well, now it's all done electronically, but you send it in to the IRS. If you overpaid through all of those channels, then you're going to get a refund. but your final tax amount is your actual tax bill. Okay, so one last income tax vocab lesson that we'll go through today is something called modified adjusted gross income. We talked about adjusted gross income, or AGI, earlier. This modified adjusted gross income, or the acronym is pronounced MAGI or MAGI. I tend to lean into MAGI. MAGI is used to determine a lot of things that have to do with retirement planning. Whether you would be eligible for tax credits, whether you are eligible to deduct IRA contributions or contribute to a Roth IRA, and whether you have to pay extra tax on net investment income or something called IRMA, which is income related monthly adjustment amounts, meaning that you would pay higher Medicare payments. All of those things are determined by a MAGI calculation, and each of the MAGI, or each of those things, has a different calculation to get to MAGI. So MAGI isn't always exactly the same number. But basically what MAGI is you take that adjusted gross income number, the AGI, and then you add back in some of those above the line deductions that we talked about earlier. They're different for each one of these categories, so we won't go into those. Just know that when you hear MAGI, usually it's pretty close to the AGI number, but it's going to have some add backs, some things added back in that you were able to deduct above the line. And then that MAGI number will determine eligibility for all of these things that we've talked about here. Well, hopefully you enjoyed this and learned a little something today. I just want to remind all of you that I do have both a YouTube channel, Retirement Planning 411, and the discussion group on Facebook by the same name. If you found me on YouTube and have not yet joined the Facebook group, I do encourage you to do so. It's a great place to share information about retirement planning. You can ask questions, you can give your own insights, and I post a lot of educational pieces on there as well. So new content will be added to both of those regularly. We're just getting started here now, but there'll be more and more coming on a weekly basis. Thanks so much for watching.